There's been calls to scrap responsible lending. In today's video, I'm going to show you exactly what this means for the lending landscape and more importantly, what it's likely to do to the property market. So stick around because we're in for a big one. So let's first find out what responsible lending is and then we can look at how it's going to affect the market. So responsible lending is under the NCCP, which is short for the National Consumer Credit Protection Act, and it was introduced in 2009, as we can see here. Its legislation was as a result of the GFC, the global financial crisis, and it was essentially designed to protect consumers against lending organizations. A part of the NCCP was a section known as responsible lending, and it covered three main items, as we can see here on ASIC's website. The main items were, firstly, lending institutions must make reasonable inquiry on a consumer's financial situation so that their needs and requirements are met. Secondly, the lending institution must take reasonable steps to verify the customer's financial position. And finally, they must make a preliminary assessment. And that's just an assessment to confirm whether the loan contract would be not unsuitable. So an unsuitable loan would be putting someone in a loan contract where they may have difficulties to meet their repayments. Now, understanding the high level, we can go into the details as to what exactly that means and what exactly lenders do to complete their obligation. So for lenders to specifically fulfill their obligation under responsible lending, they'll be doing three primary things. The first one is assessing your ability to repay the mortgage. So if they believe they'll be putting you in a situation where there's a high chance of you defaulting and being put in hardship, then it would be considered irresponsible lending. The second thing for them to do is review your regular expenditure, also known as your monthly living expenditure, and it really coincides with the previous point. And finally, they're looking at your income source. So if you're on a short-term contract which is ending in 2 weeks, could potentially be considered irresponsible lending. And if you find value in this video today, consider hitting that subscribe button and smashing that like button. What would a world without responsible lending look like? Well, firstly, we'd see the lenders increase the speed in which they turn around applications. At the moment, they've been the slowest we've seen in 3 years. It's because without responsible lending legislation, lenders wouldn't necessarily need to go through the rigmarole and red tape they're going through right now. The next thing we'd expect to change is for lenders to start making more common sense decisions. The amount of times I'm left scratching my head is beyond comprehension. And an example of this is if you've got a home loan and you've been making your repayments on time every time for 4 or 5 years. Lenders under responsible lending still need to make a complete assessment of your application. And if you don't pass their rigmarole of requirements, then wouldn't be able to necessarily refinance you, even if it means reducing your interest rate and reducing your repayments, putting you effectively in a better position. And finally, a world without responsible lending, we'd expect lenders to decrease the criteria in which applicants need to fulfill. Essentially, lending criteria would be simplified as there's less red tape and government regulation. What impact will the removal of responsible lending have on the market? Well, the first thing I'd think is that lending becomes easier to access, and as a result, we'd expect there to be more lendings in the market. Now, if we look at how the Australian house prices move based on more lendings in the market, we can look at this graph we've got here, and we can see it's the Australian house prices and the household debt, and in the blue we can see the Australian house prices, and in the red we can see the household debt to GDP ratio. So essentially, the graph shows that there's a high correlation between the amount of debt Australia has and the prices of the Australian properties. The market's so complicated and there's many factors why property prices will increase. We can see here is another graph, and the data shows that when the interest rates decrease, property prices also increase. So let's have a look at the graph in detail. So what we've got here is in the red, we've got the home loan interest rate, and in the blue, we've got the median house price. And we can see as the interest rate decreases, the property prices increase. Now, it all comes down to affordability. The more people can afford debt, the more money they can loan, and the more money they can loan, the more they can spend on properties. So we can really see that with both the previous graph and this graph, they're both predicting that the more people are able to borrow, the more property prices will increase. And what we've got here is more data, and this data is based on first homeowners versus non-first homeowners and how much on average they're borrowing. So let's take some sample data and then we can look at how that affects property prices based on the median / average sale price. So in 2004, if we look at first homeowners, about 204,000, and if we look at non-first homeowners, about 220. Now looking at the average house price back in 2004, what we've got here is, let's go in the middle. So for Queensland, it's about 220,000. Now we can see that New South Wales all the way up to 276,000 and Tasmania is all the way down to 127,000. But that middle range is that Queensland, and we can see that for 2004 it's pretty highly correlated. Now let's scroll forward and let's have a look at, say, 2018. So 2018 for first home buyers about 350 and 440 for non-first home buyers. Let's have a look at what that means for our average property price. So going back in the middle, about 380 with the top end about 550 and the bottom end about 280, and that median mark or middle mark is about 440, which is quite central to what we're seeing here. So I think the long and short of it, and the biggest takeaway here, is that if responsible lending is removed and it allows people to borrow more money, we can expect that property prices will naturally increase as a result, because there's a tendency for when people are able to borrow more money and at a cheaper price, they're willing to do so, and as a result, it flows on into property price. Shane Oliver, AMP's chief economist, has this word of warning.
With the removal of the responsible lending obligations and of course a property boom underway, the risk is that those lending standards will be eased and people who maybe shouldn't have got a loan will end up getting one.
So if the responsible lending laws are removed, there are a few things you should do to make sure you're not caught in the trap in getting a loan you can't afford. The first thing to do is know your limit. Just because a bank says you can borrow $1 million doesn't mean you should. What can you comfortably afford? And this brings me to my second point, which is to prepare for higher interest rates. Over the last 40 years, interest rates have on average been about 7%. So with this in mind, it's better to prepare for a higher interest rate than where we are right now, which realistically, we have the lowest interest rates of all time. And my third and final point is to keep a cash buffer so that if in times of need, you can always use this to get you through them. Here at Hunter Galloway, we get home loans approved. So if you're looking for a mortgage broker and live in Australia, we can help. Visit us online at huntergalloway.com.au or call us on 1300 088 065. Thanks for watching, and I'll catch you next time.